Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, stocks wavering after closing at new highs as investors digest the latest batch of earnings and try to suss out what the tariff impact is on each company. Speaking of which, we're going to dig into results from General Motors and CocaCola as the latter announces plans for a cane sugar drink. And we'll look at the future of the Fed as pressure mounts on the central bank ahead of its interest rate decision next week. Let's get a check of the equity markets first up here this morning. The S&P 500 and the NASDAQ both closing at records yesterday, and both are now falling today. In particular, the NASDAQ leading declines with that 1% decline almost, and the S&P 500 off a third of 1%. The Dow hanging on to a gain for now of nearly 70 points. And taking a look at the bond market as well here this morning, what we see across the curve, a little bit of declines here for yields, but not big, as the 10-year yield settles more lower than it has in recent days, 4.36%. Well, Treasury Secretary Scott Bessent seemingly showing some support for Fed Chair Jay Powell amid a barrage of insults from the Trump administration, saying in a Fox Business interview this morning that he does not see a reason for Powell to step down right now and that he should serve his full term through May. This follows Bessent's comments yesterday suggesting the entire Federal Reserve should be examined. Queens College Cambridge President Mohamed El-Erian posting a contrarian view on Fed Chair Powell's standing on X, saying Powell should actually step down to safeguard the Fed's operational independence. Joining me now on this, Greg Ip, Wall Street Journal chief economics commentator, and John Hilsenrath, Yahoo finance contributor and StoneX senior advisor, who also covered the Fed for the Journal for quite a long time. Thank you, gentlemen, for being here. Greg, it's really interesting to see Mohamed's view this morning that Powell leaving would actually safeguard the Fed's independence in some way. He thinks that whoever replaces him could sort of reassure the markets. What do you think?
I do not understand his logic, not in the slightest. Nobody would be asking for Powell to resign if Trump hadn't started pressuring him to resign. So the logic seems to be given to the president's pressure and the Fed will be more independent. I'm afraid I don't really get that. As to reassuring the markets, is the job of the Fed to reassure the markets, or is it to ensure that we have full employment and stable inflation? Somebody needs to explain to me how the president, the Fed becoming essentially another arm of the White House, would reassure us that in the long run we will have full employment and stable inflation.
And John, it also feels a little bit like the administration is sort of talking out of two sides of its mouth, right? Trump saying, oh, well, I'm not going to remove him unless he gets removed for cause. Bessent saying it doesn't seem like he needs to step down, but we need to examine whether the Fed is seeing mission creep. I mean, what do you make of all of this commentary?
Yeah, I mean, well, a couple of things. One is I agree with Greg that Powell resigning, I don't see how that would do anything to safeguard the institution's independence. In fact, what I would argue is that the administration's behavior has already compromised the Fed's independence. And I think people are talking about the wrong person. I don't think Powell is going to leave the Fed before his term is up. But I think it's already clear that whomever the president picks to succeed him is going to make some effort to deliver on the president's wishes for lower interest rates. And it's not at all clear to me that lower interest rates would help the Fed deliver on its mandate of stable inflation, which is the Fed judges to be a 2% inflation level. So I think the Fed's independence is already compromised. One last point. When Scott Bessent was talking yesterday about a full review of the Fed's operations, I see that as an ominous sign. I think this fight about Fed operations and independence is coming next year to the regional Fed banks. As soon as any of them start dissenting against a new chair on rate cuts, the president and Republicans in Congress, I think, are going to be coming for them, asking why unelected officials are getting in the way of the president's interest rate agenda.
Greg, why do you think the market isn't reacting more to all of this, right? It does seem like what John is saying is sort of happening. And you get, I mean, you've seen this playbook from the administration in many other realms where you sort of do this chipping away, the rhetoric heating up, doing things like John is talking about as well. Is it just so incremental that the market doesn't react?
Well, certainly there is a tendency that the shock value wears off the more you get exposed to it. We saw that with the tariffs, right? I mean, the tariffs are now, 13% versus 2% a year ago, and the market's at a record high. And I think there's an element of that with the attacks on the Fed as well. But I think the more relevant reason you're not seeing the market react more is that they're essentially saying, well, what if Trump does fire Powell? We will have lower interest rates. Markets like lower interest rates. What are the consequences? Well, I think in the long run, we will have higher inflation, but that's the long run, not the short run. Markets aren't very good at discounting the long run. And if you essentially steadily corrode the institutional safeguards of our system, that system's been around for many, many years. You don't lose the benefits of it overnight. It takes time. So it may well be that the consequences of turning the Fed into essentially an arm of the White House will not actually show up under this president's term. Some other president will pay the price.
Do you think that, John, I'll put this one to you, this Florida congresswoman who claims that Powell lied under oath when speaking about the renovation, do you think that'll have any legs in terms of an investigation?
Well, I mean, I think it's already having legs in terms of Republicans in the White House using it to put pressure on Powell and embarrass him. Greg just wrote a column about this issue, and I thought he made a really interesting point, which is that the wall at the southern border has experienced really much larger cost overruns. And if there's going to be investigations into cost overruns on government building projects, maybe they should put the wall on the southern border on that on that agenda. Of course, that's not going to happen, but I think Greg made a great rhetorical point in his column on this issue.
Yes, that was indeed an interesting comparison that Greg made. Guys, I want to switch gears a little bit and talk about the sort of underlying...
Julie,
yeah, please, go ahead,
can
Greg,
I make one last point to what you just said?
Please.
I think what the administration is doing right now is looking for any reason. So the Supreme Court has basically said you can't remove the Fed chair without cause. So they're looking for a cause. And if the end result of this is that they succeed in either firing Powell or forcing him to resign, I think, leaving aside the legality and all the politics of it, that the principle will be established that if the president wants to get rid of the Fed chair and is creative enough, they will come up with a reason to get rid of that Fed chair. So in some sense, the fact that the Supreme Court says you can't fire him without cause will essentially be a moot point, because the president will be free to essentially come up with a cause anytime he wants to remove the Fed chair. So one way or the other, if Powell is forced to resign because of this pressure campaign, we will have established the principle that the chair is essentially serving at the pleasure of the president.
And again, to sort of put aside the Fed independence question for a moment, I'm curious your views of the underlying economic situation, right? Because whether the president is right or wrong that the Fed should cut interest rates now is sort of separate from the actual question of whether the Fed should. In other words, traditionally his opinion should be somewhat irrelevant to what the Fed is doing. And I want to ask you guys about that underlying economic question. Had an interesting conversation yesterday with Chris Watling of Longview Economics. He's a global economist, their chief market strategist. And he actually thinks that the U.S. economy is weakening more than the surface shows. And I want to play for you what he had to say.
I think the US economy is getting softer. Just look at housing. There's nothing going on, no activity. If you look at the industrial cycle in the US, it's flat. There's no growth for 3 years. So there's tight money and tightening fiscal. Look at services ISM, barely at 50. I mean, that's terrible. I mean, normally you'd say, ISM manufacturing's been below 50 for 3 years, pretty much. That's pretty troubling. That's not an economy that's any better than stool speed, really.
So it's interesting, Greg. He didn't really talk about inflation there. He talked about some of the other underlying elements. What's your view on what the Fed should be doing here?
Well, I actually think there is a case for the Fed to be easing now. If I were sitting around that table next week, I would be making a case for the Fed to ease, or at least put on the table a cut for September, assuming the data doesn't go against you. Chris Waller made a case for easing relatively soon. He's a governor on the Fed. I thought a lot of what he said was relatively convincing. But I don't think it's a slam dunk. Look, inflation it's coming down, but it's still above the Fed's 2% target. I happen to think that the likeliest path of inflation in the next few months is downward, because a lot of the most inertial elements of the cost of living, like housing, are steadily cooling off. And if you look at the labor market, I don't think it's falling apart, but it's clearly got slack in it, and that shows up in the form of lower wages. And you can't get a wage price spiral if the labor market isn't tight. The relevance of Fed independence, Julia, it's not what happens in the next month or 2 or 3 or even 12, because as Milton Friedman told us, the lags between monetary policy, and that's good or bad monetary policy, are long and variable. Where this matters is what happens the next time the economy's heating up, or we have inflation that's putting, or we have upward pressure on inflation. Will the Fed have the freedom and the conviction to move to preempt those pressures, or will it have to defer to what the White House wants?
Well, and even now, and I know
can I take the other side of
can
I take the other side of Greg's argument? I'm going to make an argument that the Fed should not be cutting interest rates. It's right to hold the line, and it's not at all clear to me that a rate cut in September is going to be the right move to make. And here's how that argument goes. You know, the low point of inflation is so far in this cycle. We hit it almost a year ago in September of 2024. The Fed's preferred measure of inflation hit 2.1%, and we bounced off of it. We haven't been back near that. The core inflation rate, which is more stable, which takes out food and energy, hasn't gotten below 2.5%. I think there's a risk that we're not going to get near the 2% inflation target in the foreseeable future for 3 reasons. One is tariffs. A lot of economists say, well, that's a one-time price shock. I disagree. I think tariffs are a tax on supply chains. I think there are long runs effects that put upward pressure over a medium run on goods prices. I think the Fed's independence has already been compromised. And Greg mentioned Chris Waller making a case for lower interest rates. Chris Waller is rehearsing to try to get the Fed job. I think it's evidence of the idea that the next Fed chairman is potentially compromised. The core of Chris Waller's argument is that a neutral rate, a rate that doesn't push inflation up or down, is closer to 3%. I think the evidence based on how inflation has behaved over the last year is that a neutral rate is closer to where we are right now. So I don't think it's a slam dunk that the Fed should be cutting interest rates. And I think it is a slam dunk that they should wait to see how inflation behaves over the next few months before they jump into the pool on this. I think there's a real risk that the neutral rate is about where we are right now. And if the Fed moves too aggressively, we're going to get an uptick in inflation. And the real problem, I think, for the next Fed chair and for the market, which hasn't woken up to this, is that we might not see 2% inflation again for a long time.
Greg, I'm going to let you get a quick last word in here. What would be the risk for the Fed in waiting?
I think the risk for the Fed in waiting is that they end up behind the curve. I mean, I actually have been bothered a little bit by a lot of the sogginess we see in the labor market data. Now, the last June report was okay, but if you look at things like the collapse in hiring rates and so on, and like I said, the weakness in wages and all those sorts of things, I wouldn't put it, underlying economic growth is below potential. So it's an economy that looks to me like it's starting to develop some disinflationary slack. And even though, whether or not you cut rates, the current level of the federal funds rate, which is between 4.25 and 4.5, you know, John and I can have an interesting discussion about whether neutral is 3%, 3.5, or whatever. Where we are today is still above neutral. And so it is a somewhat, you know, moderately restrictive stance. So, but I think also where John and I aren't that far apart, the truth of the matter is, if you look at the median Fed official here, they expect to be cutting rates by the end of the year. It's whether they do it in July or September or perhaps after that. I don't think it's terribly consequential for the economy. And if they want to take a little bit more time to see if, you know, the evidence of disinflationary pressure actually manifests itself or is derailed, I don't think that's a costly strategy.
All right, guys, we've got to leave it there. But obviously, we've tapped into something here. We got to have you both back soon as this goes on and as we get more economic data and probably more noise from the White House. Greg, John, thank you.
Thank you.
Thank you.
Treasury Secretary Scott Bessent telling Fox Business today that negotiations for a future U.S.-China trade deal have reached a, quote, new level and that he plans to meet with Chinese officials in Stockholm for additional talks next week ahead of the August 12th deadline for steep reciprocal tariffs between the nations. Joining me now, Yahoo Finance Washington correspondent Ben Worschel. So what is your take on this latest news here, what seems like on the face of it a positive development?
For sure, yeah. I mean, that's definitely how Treasury Secretary Bessent tried to express it. This will be the third meeting between the U.S. and China after ones in Geneva and London earlier this year. What I think the main focus for an agenda item for this meeting that Bessent underlined is extending that deadline you mentioned. On August 12th, a 90-day pause between the U.S. and China is set to expire. Bessent has been warning for months now that markets shouldn't worry about that's going to get extended. And the word he used today on that extension is likely, a likely extension there. So that would definitely be a very positive for markets if he can deliver that aspect of it, just simply an extension of these tariffs. What Treasury Secretary Bessent is saying is on the table for this meeting as well is essentially an increased imports into China of U.S. product. He talked about how the U.S. is increasing its manufacturing. He hopes China is increasing its importing. He called that a home run for the global economy if they can reach some sort of agreement there. Whether that comes to pass remains to be seen. But those are, I think, the two main takeaways people are going to be watching for from this meeting next week in Sweden, as well as whether it sets up a bigger meeting down the road between the President Trump and Xi Jinping, which is potentially on the table for later this year.
And Ben, what about other deals? Because Bessent has talked about a rash of other trade deals coming. What do we know about those?
Yeah, so this is a separate track. So the China is August 12th. Nearly every other country in the world is on an August 1st deadline. And that's the word Bessent used today was a rash of deals. I would note that earlier this month, he talked about a flurry of deals at the start of this month before things were delayed. So I think markets will be kind of waiting to see what actually materializes there. There's been months and months now of promising a lot of deals coming, and we only have a few in hand so far. Most in focus, clearly, is the European Union, which has this August 1st deadline. Negotiations are ongoing, but the European Union has made a lot of noise in recent days about how they're looking to impose retaliatory tariffs if there is no deal in place. So there's kind of a plan B scenario if talks don't materialize by August 1st that could see a whole new wave of duties from the European side in addition to what President Trump has promised.
Ben, thanks a lot. Appreciate it.
Sure.
We got much more markets action coming up. You're watching Market Catalysts. General Motors topping second quarter estimates, even as tariffs added more than $1 billion in cost for the automaker. GM expects $4 to $5 billion in gross tariff impacts this year, but still says it's making solid progress to mitigate that effect. Joining me now, Brian Sponheimer, Gabelli Funds Portfolio Manager. Good to see you, Brian. So as we look at GM and sort of weighing costs from tariffs, weighing the underlying business, what are your sort of big picture takeaways?
I think they're doing, first of all, thank you very much for having me on. I think they're doing everything that they can right now. You know, you talked about $4 to $5 billion of gross impact from tariffs this year. I think that they can ultimately mitigate about 30% of that through cost, through some pricing initiatives. But if you look at the overall business, the light truck and SUV market continues to move in their favor. The products that they're coming out with are very solid and being very well received by the marketplace. They're doing a good job on inventory. They're moving production to the United States. They're spending $4 billion on that. Ultimately, they'll be able to generate about or produce about 2 million vehicles in the U.S. Their lines of production are going to be very flexible as it relates to internal combustion engine versus EV production. So when you look at what Mary Barra and her team are doing, they should really be commended for the job they're doing in what is another very difficult market for the auto industry.
So in other words, you're saying what they can control, they are controlling well, but between tariffs and the sort of auto market in general, the cards are stacked against them. I mean, when is any of that going to change?
Well, if you look at when Mary Barra took over and what she's had to contend with as CEO of General Motors, I think the one constant has been that markets have always been volatile, whether it is UAW strikes or Japanese tsunamis or natural disasters or COVID or something like a trade war. It's never necessarily been smooth seas for her team. But I think, when you kind of take a step back and you see how many different strategic initiatives that this company has undertaken, whether it's getting out of Europe, whether it's getting out of sedans, whether it's moving into the EV market in the right way, they truly, to your point earlier, have done everything that they could do to really put themselves in a position to succeed in the event that markets ever do decide to work in their favor here.
I'm curious about their EV strategy and whether you think, they're not certainly the only automaker to be caught a little off guard by some of the changing, not just political winds, but also consumer tastes when it comes to EVs. What do you think of the strategy with regard to EVs?
Well, we took a trip down to their Spring Hill, Tennessee manufacturing plant last year and saw how GM can really be agnostic as far as how the market works as it relates to internal combustion engine versus electric vehicle demand. Chevy Equinox can basically be built in either capacity in that facility. So they're trying to be as flexible as possible. Clearly, it has been a slower market to develop, and the removal of $7,500 incentives to buy new EVs is clearly not going to help the market. But I think that the EV growth that is expected throughout Europe and China is going to come here eventually. So all you can do necessarily as an OEM is just position yourself for when that market does develop. But in the interim, you have to be able to be cash flow positive in a very material way to pay for the spend that's required to make that journey possible.
And Brian, when it comes to owning General Motors, do you have a preference for it? It sounds like you're still, sort of maybe reluctantly or, despite a lot of headwinds, still positive on the stock. How does it then compare versus a Ford or some of the other competitors in terms of whether you want to own it in your portfolio?
Yeah, I think just taking a step back, I think it's very difficult to own automakers. I'm speaking more for what Mary Barra and her team have done, not necessarily for the stock itself. We've been involved as investors in the auto industry for over 50 years here and have spent a lot more of our time and focus on the automotive aftermarket. So the 290 million or so vehicles on the road in the U.S. as opposed to the 15 to 17 million that get sold every year. And the cash flow generative properties of the aftermarket parts retailers, of the supply base where you don't necessarily have the same product exposure that OEMs do. And, as it relates back to GM today, part of the reaction to the stock today is on weaker guidance for the back half of the year. Part of that guidance is for spending on the next generation of light trucks and SUVs that they have coming, which is a natural occurrence for this company, for any company in a 5 to 7 year cycle. So it's a very capital intensive industry. It's one that the stocks generally screen inexpensive and a lot of times inexpensive for a reason. But when you take a look at GM in a worst case scenario this year at 8.5 times earnings on a $50 stock, you're starting to get to the point where risk can be appropriately priced in for some of these names for sure.
Gotcha. And I love that perspective on the number of new vehicles on the road versus the number of existing vehicles on the road. Brian, thank you so much. Appreciate it.
Julie, thank you very much.
We got some trending tickers coming your way next. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Allie Canal, live from the NASDAQ, and let's take a check on the markets here. About 1 hour to go into the trading day, and we're seeing the Dow up around 0.1%. The NASDAQ is down roughly 0.6%, with the S&P down 0.2%. So a mixed picture across Wall Street at this point, and this comes after we saw record closes for both the NASDAQ and the S&P. I also want to take a look at Treasury yields. We're seeing 10-year yield hovering at around 4.2%. 0.4% below that level. Same with the 30-year yield, firmly below that 5% level. And these were levels that we hit last week, but it seems to be some relief there in the bond market. And the US dollar index falling once again today. This is one asset class that has really struggled under the weight of Trump's tariff announcements. And then earlier we did hear from Treasury Secretary Scott Bessent, who reinvigorated those attacks against Jerome Powell and the Fed that weighed on the US dollar index. We also saw gold edge up a bit on that news. And then I also want to take a look at oil prices. We are down another 1%. I believe this is the third straight session that we're down, trading right around $65 a barrel for crude. And this comes as trade talks continue to intensify. We have that August 1st deadline approaching. So traders really have their eye on the latest tariff developments and what comes next on the trade front here. But keep it right here on Yahoo Finance. We're going to continue to track all the market moves throughout the trading day.
Now time for some of today's trending tickers. We're watching Kohl's, Philip Morris, and defense stocks. First up, Kohl's on a tear as part of the broader meme stock rally we've seen in recent days. Shares of the retailer up nearly 30%. It appears to be part of a short squeeze on the stock. Kohl's has a high level of short interest, representing about 53 million shares. Ali Canal still with us here. Kohl's is sort of, I don't know if this one's been on the meme list before. It's hard to predict which ones are going to pop on, but it seems like that's what's going on here.
Yeah, and Kohl's has really struggled since the start of the year. They had the firing of their CEO. There's been sliding sales, internal turmoil, and heading into even earlier on Monday, we were down about 25% year to date. But I think the pop that we've seen, we've essentially erased all those year to date losses. But again, no major company news here. This seems to be pure meme momentum. You were just talking about the short interest there. We're nearly 48% of the float. It's currently sold short, so that makes it one of the most shorted names in the market. And for comparison, GameStop is around 20%, Apple, Tesla are under 3%, but Tesla can often be a heavily shorted stock. So we're seeing this online momentum, this social media chatter. Opendoor is another meme stock name that we've been talking about over the past few days. And it feels like this isn't a full repeat of the GameStop phenomenon that we saw a few years ago, the meme stock mania. But we were talking earlier this morning with Callie Cox from Ritholtz Management, and she was saying how there's a lot of cash on the sideline, so she's not totally surprised to see this meme stock reaction, especially as retail traders have really been dominating the market since the April tariff lows. And I don't think there's too much concern either when it comes to frothiness, since we are seeing on the fundamental side of the equation strong gains in sectors like tech, industrials, financials, and communication services. So, but it has been interesting, Julie, to just see how certain names tend to take on a life of its own and just the reemergence of those meme traders there.
Yeah, and on the flip side, Opendoor shares, which have been very memey lately, they're down a little bit today. So we're going to talk about that meme stock trade a little bit later in the show. But let's talk about another company, not very memey, Philip Morris having its worst intraday slide since 2020. That's after second quarter sales came in lower than expected. The company lowered its full year expectations for product shipments. It also, though, raised its profit forecast. Nicotine product Zyn had lower than expected shipments in the quarter, with 191 million cans shipped to the Americas in that period. So, you know, interesting to see. The Zyn phenomenon continues to amaze and baffle me, but that's another conversation for another day, Hallie. But it's interesting to see the reaction in the shares here today.
Yeah, you mentioned the shipments there, 191 million. I mean, still strong, but not as high as analysts were expecting. So there was this high bar that we've really seen since the start of earnings season. Netflix, for example, closed down around 5% despite a beat and raise. Investors wanted a little more here, and it seems like same case for Philip Morris, especially on the Zyn front. The company is facing cigarette sales that are dragging overall volume growth lower. Zyn, though, now makes makes up 41% of total net revenue, and Philip Morris has been investing heavily into this product category. But there's that overarching question if Zyn can really offset some of the declines that we've seen on the cigarette side. Can that momentum be sustained here? And is it fast enough to meet the company's goal of eliminating or being smoke-free by 2023 when it comes to 2/3 of its company? So the focus in the future here is on Zyn. But if you're seeing those shipments disappoint and come in lower than Wall Street expectations, you're going to have that investor reaction, since the hope is down the line you can have a business that is primarily focused on these smoke-free categories.
Let's also talk about shares of defense stocks. RTX, Northrop Grumman, they're both topping expectations in the latest quarter. Northrop shares are higher, and they're actually touching a intraday record today after it raised its guidance slightly. It cut expectations, remember, in April. RTX did cut its outlook. It expects a hit from President Trump's tariffs. RTX did not share its expected tariff hits in its guidance here. So interesting to hear, again, this sort of differing expectations from different companies and what they're willing to say on tariffs, what they're not. But the defense stocks also, we should mention, have done really well this year.
Yeah, so for these two companies in particular, the reason that we're seeing this divergence in the share price reaction is really all about the outlooks that you just laid out there. I mean, we had Northrop Grumman reaffirming its full-year outlook, raising that profit guidance, but RTX lowered, and this is coming as a result of those tariff headwinds that you were mentioning, along with some supply chain constraints, and we've been seeing that Trump's trade war is starting to trickle through into the bottom lines of these companies. We heard earlier this morning from General Motors as well, saying that they expect, or they did have a hit of $1.1 billion in the second quarter, and they expect that in the current quarter, that's actually going to come in worse. But you were saying how defense demand remains strong, and that's really the big picture takeaway here. Globally, we have continued geopolitical tensions in Eastern Europe, the Middle East, but execution and supply chain, that's been the big focus point when it comes to the winners versus the losers. But overall, the defense sector does remain strong at this point.
Yeah, just showing a year-to-date chart of many of those big aerospace companies on the Yahoo Finance Interactive. GE up 54% this year. That is GE Aerospace. Specifically, RTX up 28% as I look here. Northrop Grumman up 19%. One of the outliers is Lockheed, which is down today on its numbers as well. Thanks a lot, Ali. Appreciate it. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, AstraZeneca's big U.S. investment plan. Senior health reporter Anjali Kamlani brings us thoughts from the pharma company's CEO. That's next. AstraZeneca announcing a $50 billion investment in the U.S. following the lead of its big pharma peers amid increased pressure from President Trump to reshore domestic production. The pharma industry is hoping to avoid strict tariffs on imported drugs. President Trump has floated tariffs as high as 200%. Yahoo Finance's senior health reporter Anjali Kamlani spoke to AstraZeneca CEO Pascal Soriot about the investment. I'm just here right now. And so did he say that was why?
Well, none of them have said that that's why.
Sure.
But we have seen other companies kind of follow suit and do the same thing, or rather AstraZeneca is following suit because of that threat of 200%. Even though we have heard from Trump that there could be a potential phase-in period, it still has companies looking at what they can do to kind of thwart or at least reduce whatever those tariffs could be. As you mentioned, Julie, I did have a chance to speak to Pascal earlier, and he did talk about the investment and sort of why he sees the push to reshore as not such a bad thing, and why the U.S., aside from the tariff threat, also has other incentives that he's able to utilize. Take a listen.
This investment is really to fuel our growth, and of course, in part to address the tariff issue. But I have to say, people never mention it, but the government has put in place a comprehensive set of economic policies, in particular, a tax policy that allows immediate write-off of investments from a tax viewpoint. This is another incentive for companies to invest very rapidly.
So looking at the incentive part of it, that helps. So we know that in the coverage for Yahoo Finance, we've talked about how there could be higher costs affiliated with those manufacturing build outs. They did select Virginia as the location of one brand new facility, as well as expansion in Maryland and other sites. When I did talk to him, though, I asked about the tariffs and whether or not it is a threat. AstraZeneca seems to be a little bit more protected because it already is looking at more domestic manufacturing for different countries. We'll get to that in a second, but talking about tariffs itself, here's what he did have to say on that topic.
Oh, actually, I think tariffs are an issue and they are a threat for some companies. I was only commenting on our company because we are so much invested in manufacturing in the US already that to some extent we are insulated, and we'll be further insulated with the investments we are making right now.
So that's one of the areas to focus on, right, is the investments that they're making. And I did talk to him about whether or not that means that now it's every country for themselves and whether or not he's going to have to replicate this kind of commitment across the globe. He did mention that in countries like China and Mexico, areas where there's a larger population that are, the company's revenues, that is where he may be looking, because 42% of the company's revenues currently come from the US. With this move, that increases to 50% and leaves the rest of the world as additional growth. Here's how he phrased that.
But, we took the view a number of years ago that we needed to supply American patients from America to the extent possible. We needed to supply Chinese patients from China to the extent possible. By the way, we don't import products from China into the US. We don't import from Mexico into the US. We manufacture in the US for the US. We took the view that the large geographies needed to have their own health sovereignty. Now, of course, we cannot build a scale of manufacturing that we are building in the US. We cannot do this in every single country in the world. So there will be some level of trading and some level of collaboration necessary. But we believe the big geographies need to have their own supply and their own health sovereignty. And that's why we have invested in the US, we invest in China, we invest in Europe.
So as you can hear, that talk about health sovereignty, that's really the new topic of conversation, and whether or not other countries will start vying for that kind of commitment will then put these companies in a bind. But if not, then the US ends up being the greatest exporter as a result.
Interesting. I love that new buzzword, health sovereignty. We've got AI sovereignty, we've got health sovereignty, we've got sovereignty in everything. Let's talk about a different story that I know you've been tracking that has been such a fascinating and sort of heartbreaking one as well. It has to do with the Sarepta Pharmaceuticals, which halted shipments of its top-selling therapy at the request of the FDA after initially sort of being resistant to pausing those shipments.
Yeah, I think Wall Street and analysts were kind of surprised at how quickly Sarepta caved essentially to the FDA request. We thought it was going to be a longer standoff in essence. It took about 3 days. So last week what ended up happening, just for a quick recap, is that Sarepta was, after earnings calls, it came to light that a third patient died with one of their drugs. This was an experimental drug, not Elevidys, which is the drug that is halted right now. But it uses a similar platform, a similar delivery technology, and that's the reason for the FDA's concern with liver toxicity in patients. So what initially happened was that Sarepta was pushing back on the FDA's request and did today in a statement say, quote, "It is important that Sarepta maintains a productive and positive working relationship with the FDA," and it became obvious that this required the temporary suspension. So considering that it wants to have better relationships with the FDA as it has other candidates in its pipeline that it needs approved, that's where this commitment is coming from. We do know that there have also been hospitals, according to some reporting, that have already pulled back on using this therapy in certain populations. So really is putting the question under the spotlight of gene therapies and how they're functioning. Elevidys, by the way, is really about half of the company's revenue, $821 million in 2024. Out of the $1.7 billion that the company got in revenues for the year. So it really makes up a good portion of the portfolio and is a reason why the the question of how long this pause lasts is going to really throw the company's solvency into question, and that's where we're watching how things unfold right now.
Okay, we'll be watching it closely. Thank you, Anja, appreciate it. Coming up, we got a closer look at Coca-Cola's strong second quarter. That's next when we come back on Market Catalysts. Coca-Cola beat analysts' expectations on the top and bottom line thanks to resilient demand in Europe that helped offset weakness elsewhere. Coke separately announcing plans to launch a new product made with U.S. cane sugar later this year. Now, joining us to discuss all of this, senior reporter Brooke DePalma. Brooke, I can't help but notice the shares are a little lower here this morning, despite the beat. Any insight, anything they said in the call that helps explain that?
Yeah, well, what we're seeing is some softness in global volumes, and that's really what's sort of offsetting this excitement that we have about another product coming out with that cane sugar. Shares are just slightly lower, down about 1% in these early hours this morning. And it's worth noting here that while global unit case volume declined by 1%, that was largely led by Asia Pacific, Latin America, and as well as North America. We continue to see pressure here in the U.S. Volumes there in North America are down 1%. That was offset by Europe, Middle East, and Africa. CFO John Murphy, though, telling me this morning that June turned out to be a disappointing month. We saw weather, economic uncertainty take a toll, but they did update their guidance. And he said, quote, as we look into the second half of the year, we're confident that we'll deliver our bottom guidance. He went on to say that we are very focused on investing to sustain our consumer base and to get volume back on track here. And it's worth noting that particularly the low-income consumer, as PepsiCo has mentioned, continues to face this, economic certainty in a more pronounced way. And so they're certainly trying to cater to value, affordability, pack sizes to get that income segment back in the door, so to say.
Something that will likely not be on the affordability spectrum will be cane sugar Coke, right? Because if you look at Mexican Coke as the model, which is made with cane sugar and comes in a glass bottle, it's a premium priced product.
Right.
So what do we learn about cane sugar Coca-Cola today?
Well, first I asked about the price point. I said, how much is this going to cost? It has to cost more. Important to note here, the high fructose corn syrup product seems like it's staying on the shelves. John Murphy told me that this morning. It's staying on the shelves here. He did not give a price point, though, of what exactly it will look like, but he did say that glass is actually something that they're looking into. They said that they're exploring the options. They could be leaning into it more in the near term. He said he's very intrigued by it. And he mentioned that when you go out to like a restaurant or you eat out and someone gets a glass bottle served to them, they sort of have like a little bit of a nicer, more elevated experience. So it seems like everything around innovation, not only with the cane sugar, but also the glass bottle also being part of that experiential factor, something else they may be using to get consumers on board.
I have to admit, Brooke, when we talk about price, I don't know how much a can of Coke is now.
I have to admit, I'm not a big soda drinker. But
I'm not a soda drinker either. And it also depends. Do you buy it in a machine? Do you buy it in a six-pack? Do you buy it,
Are you at the convenience store? Are you at Costco? Are you at a retailer?
Right.
And so something around price is also something that they did mention. We do know that revenue was driven by a 6% increase in prices. And so when you think about that, that's something that they've been working against over the past few years, is this idea that soda is expensive, that it's discretionary, that you don't need it in your refrigerator. And so they've been trying to offset that for sure. And hopefully by, once again, value, pack sizes, really leaning into that, they're hoping to get more people on board.
Good stuff. Thanks, Brooke. Appreciate it. Coming up, we got full market coverage ahead. In the second hour of Market Catalyst, we're going to zoom in on tech in just a few. Don't go anywhere. Coming up this hour on Market Catalyst, first up, we'll have full coverage of today's market action as stocks pull back after hitting record highs. Plus, in today's Investor Playbook, we'll dig into why tech stocks are taking a hit ahead of earnings. And we'll discuss the latest in crypto markets as Ether Machine goes public and a $1.5 billion SPAC deal. All that and more coming up on Market Catalysts. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here. We have a little change to mixed picture. We've got the Dow right now up about 25 points. It's not even 1/10%. The S&P 500 pulling back by the same amount today after it closed at a record in yesterday's session. Right now, it's down about 1/10%. And the NASDAQ composite is falling a little bit more here, down about 0.4%. We have seen some weakness there, as we mentioned, going into large cap tech earnings. And speaking of which, let's zero in on tech here. OpenAI and SoftBanks joint initiative Stargate appears to be off to a slow start. That's at least according to the Wall Street Journal. 6 months after the company's pledged to invest $500 billion into expanding U.S. AI infrastructure, with $100 billion immediately being put to use, Stargate now has plans to build just one data center by year end, as the two companies are reportedly at odds. Meanwhile, OpenAI Sam Altman announcing a 4.5 gigawatt data center partnership with Oracle, which he says will bring Stargate AI data center capacity under development to over 5 gigawatts. That equals about $100 billion, according to OpenAI. And he also sort of pushed back against the idea that they were getting more modest with Stargate. Joining me now, we've got Sarah Kunst, Cleo Capital Managing Director, as well as Hope King, Yahoo Finance contributor and founder of Macro Talk. Ladies, thanks for being here. And so interesting as we have this story coming out against maybe a backdrop of waiting for these big cap tech earnings. Sarah, I'm going to start with you. You're really steeped in this AI and startup world. What are you seeing in terms of this incremental pace of data center build out in AI?
I think that with the OpenAI stuff in particular, you have a bunch of guys who love to sort of have a photo op and announce a big vision. So I'm not surprised at the sort of initial rollout with Masa and Trump and Sam. I think the question is, what's going to happen? Where are they actually going to build them? And how quickly will they come online? The flip side question to that is, how soon do they actually need to be online? There's definitely a world where OpenAI seems to be hitting some road bumps. Since the beginning, people have been saying, is this thing even funded the full $500 billion? And where has that money come from? He keeps losing employees. It's a tough time right now to be Sam. And so I'm sure this is not good news for him. I think long term, it'll be fine. There's a lot more interest in building data centers than we need right now capacity for data centers.
And Hope, as we mentioned, this is as we are waiting these large cap tech earnings. Maybe we'll get a little bit more updates in terms of CapEx and what they're planning on building out in data centers. What are you focused on?
Well, I mean, for this story specifically, I think this has got to be an important partnership that Masayoshi Son has to nail. We know that he's sunk so much money into this, hasn't had great traction in his recent investments into AI and his global ambitions, but ahead of tech earnings as well. I mean, this spending on AI is still the one big theme that we are all continuing to watch. Will projections of CapEx spending be downsized or upgraded by any of these hyperscalers? Google, for example, is a big one that we're always watching. That will continue to be a key theme to watch, because that will signal whether or not they've got the clients, the traction, and if they got their investors and their board on board with the AI investments that are so critical and needed right now. The next couple of weeks will tell us if those plans are on track. I know we're going to talk a little bit later about the AI talent wars. How much of that is also going to be bumping up those numbers, I wonder. And so that is one big thing to watch. The other big thing to watch is the dollar weakening. That's always a little bit good, actually, for these companies that have global exposure. 55% of revenues for these tech sector companies actually come from overseas. So that is another major theme to watch.
Yeah, and we will talk about the talent wars in a second. But Sarah, first I want to continue on talking about Alphabet a little bit, because we're going to hear from them this week. And we've been talking with some investors who think maybe they haven't gotten their due in terms of where they stand in the AI wars. What do you think?
I am such a Google bull. I don't understand how this name can be relatively so cheap when they are doing everything that everybody in the market wants right now. If you want AI, they have it. If you want social media, if you want search, if you want enterprise tools at an affordable price point, there's almost nothing they don't have. They have excellent cybersecurity at a time when that's increasingly becoming a huge issue for consumers and businesses alike. And so, I think even if that spinoff happens and they have to set Chrome free, I think they could structure that in a way that could be really good for shareholders. So I think there's a storytelling element missing, maybe, where Satya's not sort of rallying the troops and inspiring the street. But I think that gap could actually be a huge opportunity to buy into. If I saw a dip on earnings, I would be very tempted to buy it.
Very interesting, and I like that, setting Chrome free. That certainly sounds more poetic. Maybe Satya should adopt that as part of the story to spin it more positively. Okay, so there is where Alphabet sort of and Google sort of sit here, and there is the amount that all of these companies are spending on CapEx in terms of building out data center capacity, but then there's the amount that they're spending on talent. And there, Meta at least has been the splashiest of these, has been doing it in a very public way. Sarah, I'm going to go to you again first on this, whether you think that is the right way to be going about it.
One thing Zuck has always done throughout his career is he loves to Zuck people. And I think that is exactly what he's doing right now. The psychological warfare of going to all of your biggest competitors and people that you have axes to grind with, like Apple, and just offering their very good talent an obscene amount of money, making sure that everybody knows how much money you offered them, and then watching the street, broadly reward you for that it's low-key unhinged, but it seems to be working. And I think that he is hiring, great AI talent. Is he doing it in the most sort of showy way possible, maybe to settle scores and boost the stock price more than just get talent in seats? Absolutely. Does this sort of distort the market for other late stage startups or Fortune 500 companies who now they have a bunch of AI engineers who think, oh, Zuck's going to call me next, when he most certainly won't be? Probably. Where I play at the earliest stages, it's pretty inoculated against it because these are very early stage companies with very small salaries. So it's sort of fun to watch.
Yeah, and I hope it also raises some questions about, especially in this AI world. I was recently talking to someone on the private capital side who talked about not needing as many junior folks because of AI augmentation. And that then raises questions about, these superstar people, they had to get there somehow. So, it raises some questions about where they begin.
Yeah, that's the exact worry that I have right now with the downstream impacts. And I love that Sarah is bringing up something really important, just back to all of the zucking that Zuckerberg tends to do. I mean, tech reporting hasn't been this exciting since Facebook tried to buy Snapchat back in 2013. From my perspective, I mean, this is very analogous. You've got them spending money, but they're also very publicly, I mean, the stories are out there at least, having this war. It's a war of narratives. And even if you think about the Masayoshi Son OpenAI announcement and the excitement that they've had for this, if you can show the public that you are investing in this, that you're putting all your eggs in this basket and spending that money, that goes a long way, I think, in the minds of consumers, investors, that, oh, well, it seems like, this company is doing more or that company is doing more. And I think that the challenge, though, is when you have a setback, with this OpenAI Sun partnership, or, with Apple losing its AI talent, that also sticks in the minds of folks. And I think, Sarah was making the argument earlier for why Google is such a hot stock or a hot company. I mean, I think that people had sort of a bad reaction to Bard when it came out. I mean, do we remember? That was kind of a bad flub in public. I think people remember that too. But on the talent war, exactly. I mean, if you are spending $200 million in overall compensation package for one person, where do you think that money is coming from? If Zuckerberg, if you've got Mark Benioff coming out and saying, we've got our AI writing code, and we expect that over the next 18 months, they will write a bigger portion of code, that salary is getting siphoned up from the lower levels. And that's also where the fear is coming from with entry-level workers. How am I going to get my start?
It's a big topic, obviously. I'm going to end on a little bit of a lighter note because we're also waiting for Tesla earnings this week. But at the same time, there was a report today that there's going to be more Tesla diners. Apparently, that's something that the company's planning. Sarah, have you eaten any of these things yet? I certainly haven't.
You know, this is a project that Elon has been working on for 7 years. It took him 7 years to open a Waffle House knockoff that will not be anywhere near as good as the original, I'm sure. I think when he came up with the idea, it probably felt fun and relevant for his fan base. Now it's going to kind of be one place where it's easy to go and put those bumper stickers on all the cars at once. And so curious to see how it rolls out. I don't know if it's going to be a huge valuation mover.
Yeah, I think that's a safe bet. Sarah Hope, thanks a lot. Appreciate it.
Thanks.
Thanks.
Coming up, a new company going public via SPAC, making a big bet on Ethereum. We'll discuss with the co-founder of that company after the break. There's a big new bet on Wall Street, and it's on a trend that we're seeing more and more: crypto treasury companies. Now, these are firms that hold large amounts of cryptocurrency on their balance sheets. Think, for example, Strategy, aka MicroStrategy's massive Bitcoin stash. But now the trend is expanding beyond Bitcoin to other cryptocurrencies like Ethereum, the world's second largest cryptocurrency. A new company called the Ether Machine is set to go public via SPAC with a treasury of more than 400,000 Ether that's worth roughly $1.5 billion. And the Ether Machine says it's taking a different approach than anything else on the market. Joining me now, Andrew Keys, co-founder and chairman of the company, the Ether Machine. Andrew, thanks for being here.
Thanks for having me.
Okay, so what's different about this approach?
So rather than a buy and hold approach that MicroStrategy employs, Ether is a productive asset. And with the Ether Machine, we are going to focus on institutional investors and generating risk-adjusted returns by participating in the Ethereum decentralized financial economy. So Ether earns yield if properly managed, and we are going to be doing that productively.
Okay, give me some examples of what you're talking about, what this effective management looks like in practice.
Sure. So with Bitcoin, you have proof of work where miners have real estate, hardware, and electricity. And in Ethereum, you have proof of stake where we can stake Ether, notarize transactions, and secure the network. And when we secure the network, we earn yield. So there's a productive, actively managed application that we have to do with Ether to properly utilize it to earn that yield.
So is the idea here so in the case of Strategy, for example, basically it's leveraging the company's assets and stock in order to buy Bitcoin. In the case of the Ether Machine, and then you have a premium that the stock trades at to Bitcoin, is the idea that the Ether Machine will trade at a premium to Ethereum because of some of these things that you're doing?
We think we may trade at a larger premium because we don't just buy and hold the asset, we actually actively manage it. So in perpetuity, we believe that we'd be able to earn additional yield of more so than the ETFs that currently do not enable having staking. So in an ETF, you'd basically be holding the stock, but not accessing the dividend. In this vehicle, we actually produce the additional Ether through staking and participating in the decentralized financial economy.
Andrew, I guess my question then is, what's to stop anybody else from doing this? In other words, there are some companies that have been adding other cryptocurrencies besides Bitcoin to their balance sheets. Is it just a matter of you think you'll be able to manage this asset better than they would? I mean, at some point you have to worry about commoditization of these crypto treasury companies.
So we have been in the industry since the inception of Ethereum. The team we've amassed are subject matter experts in technology, staking, and the decentralized financial economy. And I believe that we are the best team equipped to manage this risk at an institutional scale.
I'm also curious, like, if it's only an Ethereum treasury company, How many people work there, for example? How many people what kind of size of team does it take to do something like this?
We think that we should have a lean and mean team, 15 to 20. And again, I think that the differentiation here is we are not a treasury company in the sense that we buy and hold. We actually produce yield, and that generation of yield is labor intensive and technologically intensive.
I'm also curious, I know it's in the name, it's called the Ether machine, but I'm curious if down the line at some point you would expand into other cryptocurrencies that maybe share some of the same characteristics.
No, this is a pure play exposure for institutional investors that are looking to have Ether exposure and Ether denominated yield. Ethereum is experiencing power law dynamics similar to Google with search. 90% of stablecoins, tokenization opportunities, real world assets are residing on Ethereum, just like Google has 90% of searches and Bing gets a small percentage, et cetera.
I'm curious your take on the underlying prices also, because as much as we have seen Bitcoin appreciate this year, in the last few weeks, Ethereum's just been a rocket ship in terms of price appreciation. How much of that is sort of what's gone in Washington, and are there things that are in we had the stablecoin legislation passed, but in terms of the legislation being considered that will have implications for Ethereum specifically?
Great question. So Ethereum is the largest beneficiary of the Genius Act, which is the stablecoin bill, because Ethereum is home to the majority of stablecoins. So with the Bitcoin blockchain, you have one asset, a Bitcoin, and you can do one thing. You can move it from one person to another. With Ethereum, you can have infinite assets that you can tokenize, and then you can embed these tokens into digital legal agreements called smart contracts. And we've found that Ethereum has this escape velocity where 90% of tokenization and real world assets and stable coins are residing on Ethereum.
Andrew, thanks so much. We'll keep in touch, see how it all goes. Appreciate your time.
Thank you.
Coming up, we got some of today's trending tickers plus two big railroad names looking to buy up a rival. We're breaking down the latest developments next on Market Catalysts.
Welcome back to Yahoo Finance. I'm Ali Canal, live at the NASDAQ. Let's get a quick check on the market action about 2 hours into the trading day. And you're seeing a mixed bag across Wall Street right now. We have the Dow, the only index in the green, up just around 50 points. The NASDAQ composite is down around 0.5%, although we were off the session lows. The S&P 500 is down around 0.1%, and this comes after the NASDAQ and the S&P both hit that record close. We'll see if they can turn things around and continue that streak of all-time highs. I also want to take a look at the Russell 2000. We are up modestly today, around 0.5%, of course, year to date. This is one index that has really struggled to see significant gains amid a lot of this volatility that we've seen on the trade front. Speaking of trade, Secretary Bessent did say that the U.S. will be restarting those negotiations with China, but we are seeing markets in general look through this until we have tangible news of a deal here. I also want to take a quick check on Bitcoin prices. We are below $120,000 a coin, but we've seen this insane run up in the crypto space in general, and this comes after the passing of the Genius Act. That was that stable coin framework in Congress. We have a lot of companies coming out and adding Bitcoin to their balance sheets, and along with the inflows that we've seen from companies like BlackRock, including some of that crypto exposure that's only added to this bullish run. Gold also continues to trend higher. We are up around 30% year to date. And then finally, let's take a quick look at oil. We are down just around 1% today. Year to date, we are down nearly 10%, trading just around $65 a barrel there. We'll keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout the trading session.
Now, Now time for some of today's trending tickers. We're watching railroad stocks, Microsoft, and Equifax. First up, railroad stocks rising on M&A chatter. Warren Buffett denying a report out this morning from Semaphore and Reuters that railroad operator BNSF, which is owned by Buffett's Berkshire Hathaway, tapped Goldman Sachs as it looks to acquire a regional rival. Buffett telling CNBC no one from Goldman has spoken to him or Greg Abel about this deal. That follows news that Union Pacific is also exploring an acquisition of Norfolk Southern. So interesting here to see all of this consolidation chatter here. I'm taking a look at the transports on the Wi-Fi Interactive here, and we're definitely seeing some strength among the railroads. Union Pacific up some 2%, Norfolk Southern up a bit, CSX is up as well. And Ali Canal is still with me, so it's interesting to see the price action that we've been seeing in these railroads, and also the tariff backdrop as we consider what's going on with these companies.
Yeah, and a lot of that price action moving on these reports, Warren Buffett denying this, saying that if he chose to go down that route, he would not engage investment bankers. And this is something that he said in the past. But you mentioned that potential deal with Union Pacific and Norfolk Southern. Now, these are companies are worth billions and billions of dollars. Norfolk worth $61 billion, Union Pacific worth about $140 billion, and rail consolidation has historically boosted margins, and Union Pacific margins have climbed to 40% from under 30% over the past 15 years. So we've seen this company steadily ramp up. We have the latest price action here, and this would merge Eastern and Western rail networks and reshape the U.S. freight landscape in general. So I'm curious to see if a deal gets done and what that could mean for the future of these rail companies and just travel across the board.
Yeah, for sure. Next up, let's talk Microsoft. It's accusing Chinese state-sponsored hackers of exploiting a weakness in its SharePoint document management software. It's a tool that many businesses use to store and share documents. They use that to break into computer systems around the world. In a blog post, Microsoft is pointing fingers at two groups supported by the Chinese government. That problem affects organizations that run SharePoint on their own servers versus through Microsoft's cloud. And we learned yesterday morning that SharePoint had some kind of vulnerability, but we didn't know where that vulnerability was originating. And now Microsoft's coming out with those details. The share's down a little bit today, but not seeing much move.
Yeah, investors largely looking through this, but the campaign has already hit U.S. government agencies, including the Education Department, state entities in Florida, Rhode Island. That's according to Bloomberg. Victims span sectors, span geographies, energy firms, universities in Europe, the Middle East, healthcare providers, institutions in Southeast Asia. So this is a global problem. Microsoft saying that it patched up some of that vulnerability, but researchers have called it a high severity, high urgency risk due to SharePoint's deep integration across the Microsoft ecosystem. So if you look at Outlook to Teams, that's a lot of exposure there, and that could potentially have exposed entire networks here around the world. So again, shares not doing too much today, but just points to how critical cybersecurity is, especially for a lot of these big tech companies.
Yeah, definitely. Let's get to an earnings story last. Equifax falling after giving disappointing third quarter and full year guidance. The credit reporting agency sees third quarter adjusted earnings per share of $1.87 to $1.97. Wall Street wanted to see $1.99. The revenue outlook was also a bit soft here. And with today's declines, the stock is a little bit lower here year to date, Ali.
Yeah, and Equifax is interesting too because they did see stronger than expected mortgage credit inquiries despite that sluggish housing market. Now, we still have mortgage demand pretty muted across the board at this point, but we are at a point where rates are at least lower than they were last year. But overall, we've been tracking the health of the U.S. consumer, how they're spending, what delinquency rates are telling us when it comes to that health. And so far this earnings season, we have received this message of resiliency, but that doesn't mean that there are not cracks underneath the surface. And that's something that investors will be really keen to hear more of on these earnings calls, and especially as more of these consumer-facing companies start to report over the next few weeks. What is the message here? Because as soon as consumers stop spending, I should say, as soon as they start defaulting potentially on some of their credit card payments, that could be a big problem here for the state of the economy and the growth picture that we know the Fed is really focused on as well.
Yes, if indeed that starts to happen, we'll keep an eye on those indicators. Thanks a lot, Ali. And you can scan the QR code below, as always, to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, meme traders have returned to Wall Street after Opendoor saw a 120% jump in Monday's trading session. Shares of retailer Kohl's now appear to be the target of meme stock traders. The stock was up as much as 105% in early trading. It's up 36% right now. According to data from S3 Partners, this is a heavily shorted name, short interest of nearly 50% for its publicly traded shares. Yahoo Finance senior markets reporter Josh Schaefer is with me now. I mean, the meme stock trade never died exactly. It just kind of hibernates a little bit and then comes out again here and there.
Right. Yeah. And I think that's sort of an important takeaway from whenever we start talking about this, right? Yes, 2021 came and went, right? And we all sort of said, oh, that's not going to be like a part of the market, right? GameStop was kind of a one-off.
Yeah.
It feels like every 6 months at least, right? We've been talking about one of these, but really not in 2022, right? And so that's kind of perhaps the differentiator here. Can make the joke a little bit. It's definitely not a bear market, right? We're in a bull market here. And that's sort of the risk-on vibe that you'll see, whether it be meme stock traders, whether it be the surge you've seen in crypto over the past couple months, whether it be, look at ARK Innovation Fund since the bottom. I ran that math a couple days ago. It's up over 80%. Of course, Cathie Wood in that fund owned quite a bit of perhaps speculative tech is one way to frame it, right? There's some unprofitable companies in there that have big growth stories, but this has been an ongoing theme in the market since the bottom. Now, what I wanted to sort of point out that I think is interesting is this is sort of vibes, right? You see the meme stocks going, oh, the market's risk on right now. It feels like that's the vibe. But from an actual where the money is at, the strategists I've been speaking to are saying, we're not even really that close to frothy. So Goldman Sachs has a sentiment indicator. It looks at where hedge funds are positioned, where mutual funds are positioned, where retail funds are positioned. It's reading 0 right now. And that is not what it was reading in, say, 2021, right? Or even in 2024 at the peak of the Trump excitement in November.
So what you're saying is we can't extrapolate this meme stock action to mean that the overall market's in a bubble. It's sort of situational specific.
Right. And if you're making the bubble argument, is this something you're going to circle? Of course, right? The stock market is at record valuations. We're at records for the market itself, for the indexes. And look, meme stocks are going, right? But the strategists that I speak with that sort of argue that the market could go higher, Goldman was one of them, Ben Snyder over there, Binky Chadha at Deutsche Bank pointed this out to me recently. He said where investors are actually positioned right now versus where expected earnings growth is, there's a gap there. There's a larger gap than normal. And so that tells him he thinks more people still have room to come into this market in Q3 and Q4, and that's how you get into the stock market, the S&P 500 continuing to move higher. So there's just a difference between vibes and where the money actually is, right?
That's
and
really
where investors are putting money. And I think there's something to take from that.
One other point that I want to make about the meme stock specifically is that's different in that universe now than when it began, is that there actually was at one time a fundamental case for GameStop or for AMC, for example. People were, Warren Kitty was making a fundamental case at one point in time. It feels like now they don't even pretend.
No.
Like Opendoor, it's just heavily shorted. So we're going to go in and do a short squeeze on these particular stocks. I mean, I don't know, maybe in the bowels of Reddit somewhere, somebody pointed out to me online, there's a bull case, a fundamental bull case for Kohl's. I haven't really seen that.
This isn't about Kohl's Cash, Julie. No, it's not.
What is Kohl's?
Kohl's Cash? You never use Kohl's Cash? They give you a little $20 coupon. Then next time you come back, you get a little something. See, maybe I'm making the fundamental case for Kohl's here, but if you don't know it, then maybe there isn't a real fundamental case.
Maybe that's the problem. I live in suburban New Jersey. I don't even know where there is a Kohl's. I got to be honest with you.
We got to get you some Kohl's Cash, and you can go check it out for us. You can do a little analyst check-in. Maybe we'll get some pictures from the racks. We'll see how the inventory is doing. We can do a little
channel check situation.
Yeah, we can do a whole rundown.
Okay. All right. Let's do it.
And we'll report back on Reddit and let the investors know.
Perfect. All right. Thanks, Josh Schaefer. Appreciate it. Coming up, we'll bring you a new episode of Stocks in Translation. What usually happens to Tesla stock after earnings? Jared Blickery is going to have the details next.
Tesla reports earnings after the close on Wednesday, and on today's Stocks in Translation, I'm going to be breaking down the historical market reactions in the stock as well as the options market, and we're going to begin with a look at what would have happened if you had bought just before earnings on each of the reporting days going all the way back to 2010 and then holding for various periods here. And this is going to show you what happened 1 day later, 1 week later if you're holding 1 month, 1 quarter, and 1 year. And by the way, these are median returns, and so 15 years of history here. And then these, the white here is a percentage of times that it was positive. So just as an example, I'm going to circle the 1 day. The median return there is actually negative 0.7, and then that's only positive about half of the time. And a very similar return for a week later. So statistically, you're really not doing much there. Then at a month, you turn positive with a little bit better odds, but only slightly, 52%. And then at 1 quarter, you finally get up to about 60% with median returns of 2.4%. Just in general, I like to look for at least 70% returns for a good odd, and that's just because stocks tend to go up. So we finally get that at the 1 year holding period where we have median returns of 20.2% with an average positivity rate or a positivity rate of 71%. And now I'm going to show you what happens with 1 year holdings. So if you go all the way back to 2010 after earning or right before every earnings announcement and you held for 1 year, these would be the 1 year returns. And I've blended these. It's a 2.5 year or 10 period moving average. So you can see how in 2014 this peaked at almost 200%. Then it just climbed to above zero, slightly positive. Then we got above 200% in the wake of the pandemic. Then we dipped negative very slightly there in late 2023, and we are now again positive. All this put together just kind of tells you that you're probably better off, unless you're extremely nimble, holding for longer periods of time, at least 1 year or more. And then I want to get into some of the stats that we're seeing with today's or tomorrow's options, tomorrow's options implied volatility. And first, I'm going to break this down for you. So options implied volatility measures investors' expectations of future price swings based on options prices. And here we have that number all the way to the left here. Options implied volatility, 10.7%. So options traders are expecting the Wednesday close and then the announcement. So Wednesday close to Thursday, that range would be 10.7%. And it doesn't tell you if it's going to be up or down, just the range. And then here's what happened over the last 2.5 years. The actual reaction was about 12.8%. So this tells us that options traders are expecting a little bit less volatility than we've seen over the last 2.5 years on average. And finally, in this column here, I have the average daily movement on non-earnings days since the last announcements, and that is 5%. So that is less than half of what the options traders are expecting the move to be, and even less so when you measure it against the actual reactions over the last 2.5 years. So all of this tells you we are definitely expecting some volatility tomorrow. I want to close here by just showing you what Tesla stock has done recently in relation to the other Mag 7. And in fact, I have some other mega cap names in here as well, including Berkshire Hathaway and Eli Lilly. I'm going to put, this is what's happening today. I'm going to show you since the April 8th bottom, and we can see some pretty impressive returns here. If this populates, we're going to see a lot of green. There's NVIDIA in the upper left, up 75% since then. And here's Tesla, up 50%. And then if we measure it, and well, it looks like the chart is going to do what it wants to. Let me just pull up a chart here of Tesla, and I'll show you the year-to-date price action. It does tend to be a very volatile stock. So again, if you're nimble, that's great, and you can trade this, wonderful, but probably a better long-term hold for most investors here. And you can see the stock is down about 18% year to date, still in a trading range basically over the last few months. Tune into Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. And we have more market catalysts after this.
You're looking at a live shot from the Oval Office. President Trump holding a bilateral press conference while hosting the president of the Philippines, Ferdinand Marcos Jr. President Trump reiterating his criticism of Powell in a Q&A with the press, but he did stop short of demanding that the Fed chair step down immediately, saying, quote, he's got to be out in 8 months. He also accused Powell of keeping rates high, he says, for political reasons here. He did talk about the building costs at the Federal Reserve for the renovation that has been the Trump administration's reason or excuse for criticizing Powell recently here. Also, Treasury Secretary Scott Bessent chiming in with his latest criticism of the Fed, that he says that the organization has mission creep, which is something that has come up over the past couple of days. And he says that the Fed should be cutting rates now. So basically just a reiteration of some of the recent criticisms from the White House towards the Federal Reserve. We'll be continuing to monitor it here. We had a fascinating conversation earlier in the show with John Hilsenrath, formerly of the Wall Street Journal, as well as Greg Ip, currently the chief economics correspondent at that organization. And both of them saying that the Fed's independence has already been compromised to some extent by the actions of the White House. And this is something definitely that market participants are talking a lot about. We'll continue again to monitor this press conference for any further commentary here. In the meantime, zeroing in on a particular stock here, we're looking at Circle. It's sliding after getting a downgrade to sell from neutral at Compass Point. That firm citing more competition for Circle with the passage of the Genius Act. Here with more details, senior markets reporter Inez Foray. And obviously, hi Inez, obviously Circle has, had a big run here, but there have been some skeptics that come out more recently.
Yeah, that's right, Julie. And we saw that big run, the catalyst, because of the Genius Act that was just signed into law on Friday. So that's been very bullish for the stock. But now Ed Engel over at Compass Point is saying, look, usually investors tend to sell the news around big events. So he expects a sort of retracement when it comes to this rally on the stock, which is up more than 500% from its IPO price on June 5th. But he's saying two things here. He says one is that he believes that this company is overvalued at this point, because he's saying that as the stablecoin issuer continues to expand its distribution, it will be making deals which will require it to share more of its interest income the way it does, for example, with Coinbase. So that's one point. The other one that he's making is that on the heels of this Genius Act, you are going to see fintech with more competition in the stablecoin space. So you will be having competing stablecoins out there. And that is a point that Wall Street has been making in recent weeks. But make no mistake, Wall Street is divided on this, because you have 9 buys on this stock, you have 6 hold and 4 sell. You just had Seaport Research last week, which raised its price target to $280. Keeping its buy on the stock, saying that the Genius Act is a watershed moment for the stablecoin industry, and they see Circle as a purest play when it comes to stablecoins.
Yeah, so we'll see if it plays out. But today we're seeing some air coming out of those Circle shares. Inez, thank you. Appreciate it.
Thank you.
That's it for Market Catalyst. I'm Julie Hyman. Thanks so much for watching. We've got more Yahoo Finance coming up.